Hi, everyone. My name is Chai Merchandani, and I'm the CIO and founder of Film Responsible Investments. Um, we're a sustainable investment firm that invests in innovative and impactful companies driving positive change whilst focusing on the highest quality growth companies. Um, and over time, we've been invested in software companies for many years, and we've always been selective. We've always focused on the highest quality software companies um, driving the most positive change. And over the last 6 to 8 months, we've seen a significant derate of the stock prices of such companies. And I thought it'll be helpful to share our views on why we are still invested in this space and why we think the narrative, the negative sentiment and narrative around these companies is misplaced. And our expectation is that many of the companies that we own will continue to deliver for shareholders over the medium and long term. So before we get started, here's just the standard disclaimer. Um, our investment thesis on software companies, the high quality software companies, it rests on three pillars. The first being durable moats. We acknowledge that there are a lot of software companies that are single point solutions that are easy to switch out of from a customer's perspective and are not deeply integrated with workflows. And we see those companies at risk of disruption from flows, have proprietary data that the software companies can train their AI models on and deliver highly specialized solutions, AI solutions to their customers. And for many of our companies, they enjoy network benefits or stakeholders, and which increases the value of that platform to all stakeholders. So a great example here in Australia is REA Group that many of you will know. They've done a great job at attracting all the real estate listings here in Australia and also the buyers, and as well as that they're integrated into the real estate agent ecosystem, which means that if anyone is trying to disrupt our REA group, our companies are still showing incredible growth in their business, both on the top line and bottom line, and their companies are going to be disrupted, and therefore all software companies, regardless of quality, regardless of competitive advantages, have been stolen for them. Um, uh, they're already investing in the capability. They're using the proprietary data to their advantage to then sell and offer an even more compelling AI offering, which will which will widen their lead over their competitors, expand margins, and keep the high levels of growth going. Now, as a sustainable investment fund manager, obviously sustainability uh, is important. And we are specifically invested in key verticals that are crucial for the economy and sustainability. So the first area that we're invested is in healthcare. We're invested in AI-enabled healthcare platforms that are improving decision making, that are lowering healthcare costs and delivering an amount of greenhouse gas emissions across the economy, and any way to improve the efficiency of that sector is going to lead to cost savings, but also decreasing global emissions, which is great for the environment. Now, the global labor spend is approximately $65 trillion. So that's the global labor spend is 46 times larger than that of the software spend. And we've heard in recent days that Anthropic, which is now had a $6 billion revenue month in February, is testament to the fact that these AI and software companies are now moving into the global labor spend market. So this has increased the total addressable market by 46 times. Now, yes, on the one hand, we could argue that this is going to lead to a displacement of labor, and that is certainly something that we need to be mindful of. However, there are also positives here. If we have labor in the world to support the level of economic growth that we've enjoyed over the years. And we do need, our view is that we do need automation, software, and AI to help fill that gap. Um, this year alone, about $285 billion has been wiped out from global software valuations in public markets on fears that AI agents will undermine pricing models and lower barriers to entry. And Gartner forecasts that approximately 35% of point product software companies or solutions will be obsolete by 2030. Now, and that, however, points to the fact that 65% of software companies will survive and in many cases emerge stronger. I think that the market is underestimating the importance of software layer as the orchestration layer for AI. We all know about ChatGPT and Claude, and we've got a whole bunch of open source models out there. And each of those models we're starting to see specialization of each of those models. And so for AI to be useful, we need an orchestration layer that can help us determine which model to use for each use case. In order to complete a complex task, for example, that task needs to be cut up into lots of different subtasks, and the most efficient and optimal way to complete the entire task is to delegate different agents for different uses. And now we're already starting to see that play out in the real world, happening at the software layer. And we think that the incumbent companies are incredibly well placed to monetize that. That history is on our side, and we've seen major platform shift where companies like Microsoft pivoted Microsoft Office to iOS and Android, growing their monthly active users. If you recall, 20 years ago, most of the work was done on mobile native versions. And at the time, there's a lot of concerns around the monetization potential of doing that and whether these companies could, in fact, successfully make that switch. And we saw, Microsoft, I spoke about, Adobe did the same, Intuit did the same as well. And there's a whole list of companies here in Australia that succeeded as well. Yes, there were companies that didn't make the switch and struggled in the years ahead successfully. The on-premise to software as a service shift also was another moment in history that showed the importance of never standing still. And Atlassian is an example there where they moved 200,000 customers from servers to the cloud. Now, if you remember, 20 years ago, businesses had their own servers in their office. And then when software as a service and cloud became more available, we started moving, we migrated from a one-off license fee where you paid an upfront fee to get access. The market had about the ability of these incumbent companies to make that transition from on-premise to cloud. And again, we've got examples of companies that have successfully made that transition. And now, here in the present, we're seeing yet again the software as a service to AI shift. And we've got examples of companies like ServiceNow who are already integrating or incorporating new transaction-based pricing models to their customers. We've got companies like Xero that are launching AI assistants within their ecosystem. And I mean, WiseTech is an example that has gone all the way now where they've migrated their clients from a per seat revenue model to a transaction based model. And so there's an example of a company that's directly going for the $65 trillion of total addressable. It's more uncertainty and decreases the visibility of the revenue profile in the short term, but um, but it's now playing in a much bigger much bigger total addressable market and delivering incredible value for their clients. And so our view is that in the fullness of time, the market opportunity and the revenue growth that we will see from these companies will accelerate. Now, it is important, however, for the incumbents to act now. This slide makes a case for why SaaS or software incumbents have a structural advantage. A lot of these companies have been around for decades. They've got the scale. As I said, they've got the data moat, which they can train their AI on to deliver an even better solution to their customers. And they have incredibly high switching costs. But every quarter, AI native startups come up. The AI native startups, they have speed, they've got the AI native architecture, but they don't have the proprietary customer data and the deep switching costs. Every month that goes by that the SaaS incumbents do not pivot, it's opening up space for these AI native companies. Now, we saw this a couple of years ago when ChatGPT launched and they were getting incredible amounts of traction and a market narrative around because ChatGPT was disrupting them. Now, what eventually occurred was that Google, using its strength, which was distribution, scale, data, and the high switching costs, incorporated their AI solution across with the leading software companies. There currently skepticism around their ability to use AI and distribute that across all their assets. But if a company is well run, forward-looking, and investing in the space, our view is that the software incumbents are incredibly well placed to do well. This is a slide that shows that the odds are stacked against the startups. Most do not return capital to investors. So yes, although there's a lot of hype and excitement around AI startups at the moment, statistically, most of them are likely to be unsuccessful here. If we take an objective view here, our view is that the incumbent software companies are incredibly well placed. They need to act now. And every month, every quarter, every year that goes by, their competitive advantage is decreasing. Now, but what capability? Leveraging the data that they have and leveraging the distribution and scale that they have. Yes, their competitive advantage is decreasing, but we are certainly engaged with our companies and checking in on them to make sure that they are investing in the area and delivering and well placed to win over the coming years. Here's a slide that shows that the central argument throughout history is that they built the most effective cold distribution network in the world. The refrigeration technology was commoditized, and the value went to the company that applied it best, and in this case, it was Coca-Cola. Apple, in the late 20th and early 21st century, they combined hardware, software, and internet services into an integrated ecosystem. Apple became the most valuable. We think that the same pattern applies to AI here. The companies building the infrastructure, like NVIDIA, like all the other AI hardware companies that have captured enormous value in the first wave, but we believe that the next wave of value creation will come from the application and software layer. That extends to the physical world as well. And our investment in Tesla's autonomous capabilities is an example of physical AI. So, the companies that are able to utilize AI and large language models, which is becoming more specialized, and we now have lots of choice, will do the best And we have made investments and we continue to have investments in leading software companies that are leveraging this technology. We look at the financials of leading Australian software names, companies like Xero, iStack, Prometheus, Technology One, Life360, and Block. We see strong revenue and profit growth with no evidence of long numbers. These companies are scaling, investing in AI, and in many cases accelerating. Looking forward, we see four key return drivers here. First being earnings growth. Our holdings are growing revenues by approximately between 18 to over 30% per annum with expanding margins. This earnings power can compound regardless of short-term market sentiment. These are companies that are growing structurally thanks to innovation and technology. Regardless of what the oil price is doing, regardless of what the macro backdrop is, we have strong confidence that our companies will keep growing because they're delivering incredible value for their customers. Second, the valuation upside. After the recent E-rate, many of these high-quality companies now trade on multiples below their historical averages. And as the market recognizes that these selected high-quality software companies continue to grow and deliver profit growth and are in fact AI beneficiaries as opposed to being disrupted by AI, we think that there's great upside for the re-rating of the stock over time. Third, AI monetization. Our holdings are in the early stages of monetizing AI features through add-ons, AI-driven upselling, and usage-based or transaction-based pricing models. This shifts their total addressable market from the traditional software TAM to a much bigger global labor spend TAM. We think that growth can be sustained over many years. Fourth, sentiment normalization. There's no doubt that a sector has seen some significant headwinds when it comes to investor sentiment. But despite this negative sentiment, the fundamentals do remain strong, and the robust moats, incredible AI roadmaps, we think positions them well for future return potential for the sentiment to turn very quickly here. So in summary, I just want to bring everything together. AI agents embedded in leading software platforms are, in our view, a total addressable market expansion story. The opportunity set is roughly 46 times larger than the traditional software market, but capturing it requires investment execution and capability. We believe our portfolio companies are doing exactly that. Quality compounders are trading at a dislocated valuation, with AI acting as a powerful tailwind rather than a threat. And as a result, within our portfolio, we're continuing to invest in the leaders, the incumbents with durable moats that are leaning into AI rather than ignoring it. Thank you so much for your time, and if you have any questions, please do feel free to reach out to us. Our email address is info@elmri.com, or you can contact me directly at jai@elmri.com. Thanks very much. Bye.